Well, good morning, good afternoon, good evening, wherever you might be. Welcome to this month's Intentional Success webinar. It's 2018, or at least the very end of it. We're going to talk about the past year and how to talk about it in your organization and how to talk about the year ahead. So great topics for this time of year. And without any further ado, oh yeah, I'm still me. This is still all the places you can find me. Maybe I'll update the slide next year, but all this stuff is pretty evergreen. So thank you for keeping in touch. I do want to thank our sponsors, our AV Matters and Jumpstart Workshop sponsors for this past year, included AV Franklin. Absen has joined us, HireTrack, Lasso, Flex, of course, Square AV, VER has joined us, and Avixa is a sponsor of AV Matters and the Jumpstart Workshops. So thank you to all of them for helping make this possible and helping defray some of these expenses for putting these things on. Now, why an end of the year webinar? Why don't I just do something fun? And this could be a little bit fun. What I find, and I remember the first time I was an employee and there was an end of the year company meeting, and great folks, everybody goes about this sort of thing differently, but I remember sitting there listening to the figures and the declarations and the goals and everything, and not really connecting with it, not understanding how I could participate, why I was part of this, where were we going with all of this? I didn't quite understand what the numbers meant. They were information, but they didn't help me do anything better. I didn't know how I could make a difference in all of that. And we got better at those meetings and became better at it. But over the years, I've sat through a lot of these meetings with many, many of you. So I've got some ideas on how we need to do about that. How do you review your business at the end of the year, number one, as a management team? And then two, how do you convey that to other people in the organization? We're going to talk about goal setting and talk about initiatives and action items that you will work on and how you convey that and make sure that they actually happen. And then if you'll stick with me to the end, I've got some outlook for 2019 and some recommendations for you that I'm pretty sure you don't want to miss. So let's start off by figuring out how do we do this end of the year assessment. So you're going to look at your business. You've got a lot of spreadsheets. You've got a lot of P&Ls and balance sheets and metrics and reports out of your Flex system or your R2 system, whatever it might be. What do you do with it? I mean, which parts of these things really matter? And then once you figure out what matters, who do you share it with? How do you do that? So let's start off with reprioritizing what we evaluate at the end of the year. The natural tendency for most of us is just go straight into those spreadsheets and go, hey, look, we made our revenue target. Look, profits are up. Yay, blah, 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 blah. But earlier this month, we had the Jumpstart Management Workshop here in Dallas, where we had a record number of attendees, by the way. Thank you very much. I had a guest speaker come in. His name was Matthew Mabel, and he talked to us about culture. And I'm adopting some of the things that he advised us to do and that he shared with us. And one of the things he said, if culture is important to your organization, and of course his premise was that it should be, because a whole lot of your profit is directly derived from the culture of your organization. And how you earn profit and how you solve problems and how you move forward are all culture driven. So he made a very compelling case for how important culture is in our organizations. And his recommendation was if culture needs to be important in your organization and you need to improve upon it, then start every meeting with it. In other words, every time you have a meeting, get together, and in the context of that meeting, ask what everybody's contribution to culture has been in the past week or month or whatever, since the last time you had that meeting. Here at the end of the year, as we're reviewing the year, I want to ask my management team, so what have we done as management to preserve and improve our company culture this year? And that's where I want to start the conversation. If we put culture off to last or move it down the list, as soon as we get to the numbers, everything else becomes a blur. Once you start talking about numbers, whether you had a good year or you had a bad year, all the other messages kind of get lost. And if culture is important, put it first. If you put it last, it's the agenda item you're going to drop, it's the agenda item you won't focus on. Or if you're having a bad financial time, you're not going to feel good talking about culture. So let's make sure we give culture the attention that it needs before we start working on, the more fiddly bits of the organization. So when we talk about culture, we need to talk about what has management done, and then we also need to talk about employees who have made significant contributions to the culture and how have they done that. And what we're looking for, guys, is stories. Okay, culture is about stories. What are the stories in your organization of people making choices, expressing themselves, helping others that reflect on your culture? And culture are the positive things that you want to reinforce. We all have issues inside of our organizations, and they may be cultural issues, but we don't want to emphasize, the bad issues. What we want to emphasize are the positive things. And if you want to improve the culture of your organization, focus on the things that you're doing positively for culture. Spend less time talking about, if people would clean up after themselves in the lunchroom, that would be awesome. Okay, that's not a good culture conversation. Talk about how great it is that when there's a group lunch, how everybody pitches in and cleans up afterwards. So find ways to reinforce the good aspects of your culture and do that as often as you can, and you'll be amazed at the improvement that you'll make. The second topic in my year-end review with management is I want to talk about employees. I want to talk about the team members specifically in terms of how they're executing their jobs or their roles in the organization. So let's identify which employees, first of all, have exceeded expectations and why. Why do we think they exceeded expectations? What were they doing? Let's get past all that language about, well, yeah, they did a great job, but they were just doing their job. If they exceeded expectations, why were your expectations so low? Or what did they do to do better than what anyone expected? So what's the formula of that? And again, I'm looking for stories. And also over the course of the year, you've found some employees that had untapped talents or skills. I worked with a lot of musicians. My old company, tons of musicians, very talented people. I'm in awe. I don't have a musical bone in my body. I can barely fire up my iTunes on my phone. We had some very talented people, and you look at how somebody works in their job and the challenges that they may have doing the job you're expecting of them, but then you find out that they're an absolute genius at something else. And it makes you rethink how you might engage with them to get better work out of them, to help them better, have more success at their job. So let's talk about these untapped talents and skills. And it may be, you find I remember a young man we had who just had an affinity for software. He started out just doing, QC in the warehouse, and then, ended up being the IT manager after a few years. But if we hadn't talked about these untapped talents and skills, he would never have had the chance to develop that. So let's spend some time talking about these employees here at the end of the year before we tee up the thing that everybody's waiting for, which is this financial review. And I'll spend a little bit more time on this because this is where most of us struggle. We don't know how to look at the numbers. We don't know how to determine what they tell us in a relatable way. So I'm going to break it down. I'm going to make it very simple. Here's the bare minimum you should do. And for many of you, this is all you need to do. A lot of these extra reports and analysis and things, they often don't yield anything that's actionable. It's a lot of empty information. So unless you're highly analytical with financials and with numbers and spreadsheets and stuff, and you know how to apply that data for something, I wouldn't spend a lot of time on it. But at least work with the things I'm about to show you right now. Okay, so I'm going to break it down in two areas here. I want to look at 5-year financial trends, and then I want to look at a trailing 12-month P&L comparison over 2 years. So in other words, a 2-year trailing 12-month comparison is going to be 24 columns, and every month I can add another column and shift the report one to the right. So I'm always looking at 2 years so I can compare where we were a year ago in terms of 12 months ago versus now, and look at 2 complete years all the time. So this is where I want to look at my KPIs, key performance indicators. I want to look at my cost of goods sold as a percentage of revenue and see how we're tracking. Let's look a little bit about, see how that looks. Now, first of all, the 5-year financial trends. Here's a simple spreadsheet of an organization, 5 years of rolled up financials, the breakdown on their revenue, the breakdown on their cost of goods sold, the master categories in their overhead expenses or SG&A expenses. And to the right of that, I've made a little chart, a very simple, 3-click chart in Excel, where we track their sales over 5 years. And the bold blue line on the screen is the actual sales figures. And there's a little bit of an arc in their sales progress. The dotted straight line is a trend line, which is a simple right-click add or menu add onto any chart that says, what is the actual trend? Now, typically what's going to happen is we're going to get to this end of the year meeting in 2018, and somebody's going to go, well, my goodness, we are at 6.5 million for 2 years, and now we're at 5.7 million. The sky is falling. Now, if we look at the trend line, though, we see that we are still on an upward trend. Now, we have another down year. We have another soft year. That trend line is going to flatten out, and then it's going to start to point downwards. So let's look at the overall 5-year trend and see what's going on and go back and do a little bit of analysis on that. For those of you who are at the workshop and management workshop, we use this same example. This is in your spreadsheets. And we noticed that in 2017, there's a systems jump here where this company added an extra division, which affected their overall performance. Regardless of that, the trend line still matters. The trend line is where we need to focus. Now, even though sales is trending up, if we move down to cost of goods sold and gross profit, we see it's also a curvy line, as these lines will always be, but the trend line, the dotted line, is flat. So our gross profit is flat. It's not just flat as a percentage of revenue, it's flat as a dollar amount. So over the 5 years, they've moved from $3 million worth of gross profit to $3.2 million of gross profit. It's not going well. Increasing revenue is not consistently increasing their gross profit at the same rate. Now, what would that tell us? Well, that would suggest what we see on the final chart here is that the net income for the company is trending down. Now, if sales are up and gross profit is flat and your net income is trending down, what does that tell you? Well, that tells you that your total overhead expenses are somehow trending up. And in fact, that's what we see. So we take another chart here and we compare the total sales, which was the first chart on the last slide, and the total selling expense, which is this, what we're assuming is the problem here. And we see that the selling expense is going up, which is why net profit is going down. So as a management team, this gives me a place to look. Can I improve my gross profit? Absolutely. I need to do something about my gross profit. But I also have my overhead expenses trending up at a higher rate than my cost of goods sold. So I know where I need to focus some of my energy. Now, again, feel free to stick in questions anytime you want to, and I will try and get to them. And I know I go fast and I provide a lot of information, but that's why this is recorded, so you can listen to it again. Now, moving on to a trailing 12-month report, you don't see the entire spreadsheet here, but the top you can see, there's a monthly revenue number for a period of time, and it goes way off to the right of the screen. And there's a chart here that tracks all of those months. There's a little formatting error at the bottom there, so those are months. And what we see is what you would expect in your organization is that your monthly revenue is just all over the place. You have good months and bad months, and it's just, it looks like the crisis meter on an EKG. The average that we're looking at here, and the reason this report is important, is that for every month we add, we just completed another 12 months. And if we look at the average revenue for that 12 months, in other words, an annual revenue, so as of the end of December 2008, on the bottom set of figures there, the trailing 12-month average is 374. So that tells me what my average month would be, okay? Which if I can extrapolate out to an entire year. So this particular company, over this 2-year period, their trailing 12-month average of revenue is increasing. If we added a trend line on that, you would see that trend line veers pretty sharply up to the right. This is important. A month doesn't really matter for most of our companies in this business. We're a service industry. We're very seasonal. Monthly, P&L reports are feast or famine. They're often very discouraging for us to look at. So we don't want to dwell on them. There's useful information we can get out of them. That's a whole nother webinar. But on the end of the year, I can look at an entire year. But using trailing 12 months, I can look at an entire year at any time of the year. So it captures all 12 months. It captures all the seasons. It always captures the end of the year adjustments that you make. So you see how you're really tracking on an annual basis. It's a great way to get over being upset about a bad month when you see that your trend is still upward. Now, not that we don't want to improve good months, but good months and bad months are not what make your year. It's the overall combination of the two. Now, the fourth area that we want to look at when we're looking at these reports is get into what are the key performance indicators for your company. Now, most of you in the audience are, some sort of production rental company. You're doing live events. You have a rental inventory. You're leveraging the equipment you own and the people on your staff, the people that you outsource to generate profit. So we have some very common key performance indicators that we all need to be looking at. And here are the four that I quickly gravitate to. On a trailing 12 months basis, I want to look at my total cost of labor. I want to look at how much inside and outside direct labor I have and how much administration, sales, or executive labor I have. Inside, outside direct is cost of goods sold. We call that above the line expenses. Admin, sales, and executive is overhead. We call that below the line expenses, the line being gross profit. The more business I do, the more inside and outside direct labor I actually use. All right. It doesn't matter how much business I do, my admin, sales, and executive costs are going to be pretty much the same with the exception of commissions, which is a selling cost. So I want to look at my total cost of labor and see how I am tracking. There's a lot of, somebody's going to ask me, well, what's a good number? It depends, of course, is the answer. What's a good number for your organization? And if you track this over time, and you can go back and track this over time, see what's normal for you. Typically, I'm going to see a total cost of labor of the two areas combined running about 40% of revenue for a company that's somewhere between $2 million and $10 million of income. Inside, outside direct share of that is probably going to be about half. So some variation on that. So if your total cost of labor is running more than 50%, well, give me a call. Let's get down to the bottom of it and see what's going on. If it's running under 30%, give me a call because that may not be good either. But see what is normal for your business and track that. See what your trend line is. Now, I'm also going to look at my cost of goods sold because that tells me what my gross profit is going to be. Specifically within cost of goods sold, I want to see what my sub-rental rates are tracking at. So not on a monthly basis, not on a job-by-job basis. Sub-rentals on a job cost basis or a monthly basis are pretty irrelevant numbers. On a trailing 12-month basis, they're very significant. And we can tell a lot about an organization and where they need to invest and how they need to operate differently or better based on sub-rental numbers. So do you need to own more gear or less? Well, that depends on what your optimal sub-rental number is. And that's going to tell you what you need to spend. Now, for a venue-based, if you're primarily in the hotel business and that's all you do is hotels, your sub-rental numbers are going to be quite different from somebody who is a full-service production company. If you're a box rental company, your sub-rental numbers are going to be significantly different. So what is normal for your organization? You can go back and look at a year when you were extremely profitable and see what those numbers were and see how they track to the current year. I also look at travel and logistics and supply expenses. Travel and logistics, I pick on those in particular because most companies do a poor job of recovering those costs. We tend to shrug travel costs. We do pass through with the clients. We're afraid to mark it up. We're afraid to charge them for changes. We're trying not to make noise. We're trying to stay under the radar, and as a result, many companies take a loss on travel expenses, which they should not have to do. We can track our travel costs against our travel revenue and see how well we're doing. But most of you will find, if you look at yourself right now, you're probably upside down. You're probably spending more to procure travel than you are charging customers for the travel you procured on their behalf. In other words, you're running at a loss, which makes absolutely no sense whatsoever. Logistics, trucking, shipping, that sort of thing. We also do the same thing. Customers are well trained to be astonished at how much it costs to send a semi-truck across the country. And when you tell them that the trucking cost is $12,000, they're always going to exclaim that that's ridiculous. In which case, most of the time, you're going to drop the price, you're going to eat it somehow. So I want to track that logistics number and see how upside down I am. And I've done 3 other webinars that tell you better ways of selling these things, so I won't get into that right now. But if those are not working, it's going to show up here in the KPIs. If they are working, it's going to show up in the KPIs. So let's look at it. So supply expense is another one that slips under the radar. And the reason all of these are important is in cost of goods sold, a 1% improvement in cost of goods sold is a 1% improvement in net profit. Most of you, with just by paying attention, could improve your cost of goods sold by 5% next year, just by paying attention. And it starts by reviewing the numbers, understanding what creates the numbers, and creating action items to get better results out of those numbers. This is all on you. Okay? This isn't stuff that happens to you. Cost of goods sold are choices that you make on how you use the revenue and how much profit's going to be left over for you. Good question here. Just came up looking at your KPIs. Did you leave out ops labor, or was that included on the inside? So inside direct labor is operations labor. So that's your warehouse crew, your warehouse team, your managers for the warehouse. It's also your inside technicians. Outside would be the labor company people that you hire, the freelancers that you hire, and all of these are directly related to doing work. Now, some people will push back on me and say that they treat warehouse folks as overhead, and that's fine. If that's what you want to do, you can. I can make a very compelling argument why you want to treat them as a cost of goods sold, but that's an argument for another day and probably a glass of wine. So as long as you're tracking it, that's what it is. So thank you for asking that question. And then on revenue, after I've evaluated the KPIs and my cost of goods sold, I'm going to do some revenue KPIs. And I want to compare my labor, travel, and logistics to the direct costs and cost of goods sold. I want to see what that ratio is. Many of my clients know and will remember the meeting the first time I stood up at the whiteboard and I did this revenue KPI for them on their P&L. I'll go back to a really old story so nobody thinks I'm talking about them right now, but about 10 years ago, I had a client who was spending $4 million a year on travel, and they were billing about $1.5 million. Let me repeat myself. They were spending $4 million on travel. They were billing $1.5 million. When I put that up on the board, because they weren't looking at it that way, they weren't making that comparison. Every travel expense they made in their mind was justified until I did that KPI, and a couple of people stopped breathing. Now, the good news is, just by paying attention to it, we knocked $1.5 million off their travel in the next 12 months. Changing some internal policies, how they did some pricing, we picked up another $600,000 in the over the next 6 months after that. So after 18 months, we just about got them whole. They increased their travel revenue, they decreased their travel costs, and it became a profit center at about month 18, as I recall. So it's amazing what you can do if you just pay attention to something. I also like to compare the ratio of equipment to labor. I would say a majority of you on the call, if I go look at the attendees who are on right now, that's a big crowd, by the way. That's awesome. That most of you are production rental companies of some sort, which means you have equipment and labor together to deliver an outcome, which is fantastic. The ratio between those two tells me a lot about your organization. If the equipment, the value of your equipment after discount versus your labor number is typically in a average return company, 60% net equipment, 30% net labor, 10% other stuff. So you got a 2-to-1 ratio on net equipment to labor. I'm going to find, if I go into that organization, I'm going to find a lot of processes and pricing issues that says that they're underselling labor. I will find that they're probably upside down on labor. So I want to track that number. What is ideal? Well, ideal is you want as much money for labor as you can get. You want as much profit generated from labor as you can possibly. Most of you need to reduce your expectation of profit from equipment and increase your expectation on profit for labor so that your businesses will scale better. In other words, that you can make profit at any size of event and project. So take a look at those numbers. And let me answer another question here. Question is, would show labor be a cost of goods sold versus a standard business expense, i.e. technicians' labor on an event versus a week in the warehouse? Well, they're both direct labor, okay? Whether you use them on a show or you use them in the warehouse, you're using them because you sold something. That's what makes them direct labor. That's what makes them a cost of goods sold. There's really nothing that touches a show site floor or leaves your loading dock belongs in overhead. Those are all direct costs is the criteria. So I hope that answers your question. And yeah, thank you for, you put that in the chat box. Thanks for moving it to the Q&A box. All right. And then another KPI I take a look at is, we all use discounts in one way or the other. There's a discount off your retail price, whatever that retail price might be. It might be an equipment discount. It might be a lump sum discount. If you're one of my JCA users, it'd be a lump amount, percentage off an entire project. I'm going to track those. And for some of us, we put those into the P&L. We actually put an adjustment to income in the revenue section at the top of the P&L so that we can track that. Others, we simply apply it to our equipment income and do it that way. Both ways are right. I can make good arguments for doing it either way. As long as you track it, you want to keep track of what it is that you're doing. You can also do this out of your rental management system. It doesn't necessarily have to be out of your P&L. So wherever that number comes from, do take a look at it. All right. And then this meeting is going to continue after I've talked about culture, I've talked about our employees, I've talked about our financials. Now, as a management team, we want to talk about what next year's goals are. And our financials just gave us a bunch of goals. Our employees just gave us some goals, and our culture just gave us some goals. And it did it in the right order. So if we just looked at our financials, we'd be all wound up about our travel expenses now, and it'd be really difficult to talk about a culture or employees with any meaningful thought. So talk about culture first, talk about your employees next, then dive into the numbers, and then let's talk about what the action items are going to be. So your next year's goals as a management team, how are we going to support the culture of the company? What are the things that we can individually do to contribute to support the culture of the company? What is your contribution of it? It's difficult as a management team or as an initiative to change a culture or add to a culture, but individually we can have a huge impact. So share how you as a manager are going to have that impact. As a company, ask, what are we going to continue to do better? So what's the thing that we're doing well that we want to continue to do well? And why are we going to succeed at doing better at that? So if we've shown an improvement in generating revenue, okay, how is that going to continue? Why is that going to continue? And why are we going to be successful at that? What are the things that we're doing? So let's make sure that we keep those things in reports. Is it better marketing, better business development? We're keeping our pricing updated. Maybe it's a little bit of all of those things. Who is going to pay attention to that? That's why we're going to succeed. And then let's talk about the initiatives. These are the things that we're going to start doing now. Okay? Notice the order of these things. Our goals are, 1, support the culture of the company. 2, continue to do things well. And 3, work on these specific initiatives that are going to make us better. And this is where you'll spend most of the rest of the meeting is talking about who is going to own the initiative, what authority they're going to have, how do we measure success, what's the goal, what's the budget, all the things that go with these initiatives. So I'm going to break this into two things. I'm going to talk about initiatives, I'm going to talk about action items. Initiatives are things where it takes a concerted effort over a long period of time to see the benefit. It's very hard to define a middle or an end of an initiative. It's something that you will always continue to do, but you need to start doing more of it now. An example, and I'm using his because everybody at the end of the year talks about employee development and training, and then the next year they don't do it. And it's because they didn't put the right effort behind it. So here's what that effort looks like. So for each initiative you have, you need to, one, define who's the owner, who owns this initiative, what's the scope of work they're going to work towards, and what's the deadline for making progress or measuring progress. So for this particular employee development and training initiative, we're going to focus on career path definition, right? How do we define the career path for an individual? What's the do we need to go back and redo our job descriptions and our compensation scales so that people can see where they can go in the company? How can I advance in the organization and make more money without becoming a technician or a salesperson, which for many people are like the two worst jobs in the world. So there has to be a way to have a career inside of your company. We need to do a better job of defining that in this initiative. What training resources, what's the budget for it, and what's the timing of it? In other words, when is that budget going to be applied? When are the training resources going to be made available? Don't announce an initiative and say, as of January 1st, we're a training organization and we've put aside $50,000 for training. And then all of a sudden you have 50 employees saying, well, where's my training budget? I want to use it right now. Tell them how it's going to be used. Give them some timing. Say, hey, during our slow season, from mid-June to late August, we're going to release budget for these initiatives, and we're going to offer some things to you to help you get trained. Another initiative in this, or another task in this initiative is, defining employee onboarding and orientation. Our goal for this is an employee satisfaction metric. So this is the thing that we would measure to see how well we're doing on that. And we're not going to get to a certain point and stop. We're going to keep measuring it. Okay? And then, of course, we have to define who the project owner, how much budget they have, and what are the milestones along the way. One, we get a plan. Two, we make, the first set of training modules available. Three, we have career path definition defined and approved and shared with the employees, that sort of thing. So that's how I would develop an initiative. And an initiative won't be done in 1 year, because next year, you have to continue on this initiative to take it to the next level. Now, action items are a little bit more concrete and probably a little bit more familiar to us. As live events people, we tend to be very reactive. We know how to deal with emergencies. We know how to put out a fire. Tell us what the problem is. Give us a credit card and we'll fix it. That's typical of an action item. It's very short duration. Here's an action item. I'll use that travel cost to revenue example that I was talking about earlier. So here's an example where we reviewed the travel KPI, says, the costs were increasing, but the revenue is flat. I'm going to share with the company a story about a project that everyone knows that they will relate to. Stories are very important in all this when you're trying to initiate these things. So everybody's going to relate to that job, that big job we did for Pfizer where we had the travel fiasco and this and that happened, and relate that to the KPI. Okay. In this action item, management has determined that they need to change the expected markup that salespeople are using. They're researching travel costs and they're adding 15% on it, thinking that that's enough, or that's all the customer will bear, and they're going to increase it to 35%. And the pricing will now have to come from the travel desk instead of the salesman doing their own research, because they tend to find really cheap flights, but then buy really expensive ones for their technicians. We're going to monitor that the pricing is being quoted correctly or accounted for in the budget. Okay. And then we're going to revise the product list and Flex or whatever your software system is to support this pricing increase. So we need to do whatever tactical things need to be done to make this initiative or this action item sustain. We're to define who's in charge. You got Jane Smith in charge of this. She's going to monitor the pricing and costs. She's in charge of compliance. And every 30, 60, and 90 days, we're going to review the KPIs with Jane as a management team to make sure that she's on task and that she's getting the support that she needs. And I would present it just this way in the company meeting that we're going to talk about in a minute. Because your employees need to know what's going on and what's expected of them and what you've authorized to happen. Now, we've done this end of the year review with management. It's time to organize that company meeting. Here's my agenda. Very simple. I want to talk about company culture. I want you to share a story. Stories are really important. Okay. Exemplify the story of culture that you want people have. Tell some positive stories. Tell multiple stories if you want to, but talk about culture first. And talk about how you're going to reinforce the culture going forward, some of the commitments that management is making to that. If your employees want to raise their hand and make a commitment, why not? This is a great time to do all of that. Then move on to talking about employees and talk about key contributors. If you do end of the year awards, this is a great time to fit them in, share the stories that go with it. I have a client that does shout outs, I think is what they call it. They do it at every company meeting. They have them like once a month. And employees make a tribute to somebody else who did something really good for them, and they tell the story about it. And that part of the meeting, I've sat in some of those, they go on 20, 30 minutes while people very generously share stories of how somebody else helped them through a day, did something for them that made their job better or made the company better. They felt needed recognition. It's a rewarding experience to watch people do this because they're very, very sincere. Now that we've talked about employees and culture, we can talk about financial reviews. And in doing a financial review, I want to talk about factors that employees can affect. Okay, I don't want to talk about the phone bill. Nobody can do anything about the phone bill. I want to talk about revenue and how people can help with revenue. You know, when somebody walks into your ballroom and you see them looking around, go up and say hello, shake their hand. Maybe they give you a business card. I had an employee who was stellar at that. I mean, he came back from every event with a pocket full of business cards because he spotted every meeting planner or event planner that walked in the ballroom to check it out. And he went and chatted with them. He brought back all these fantastic leads. That's how we can all contribute to revenue. Okay. Change orders. You know, you want to contribute to revenue. About 4% of your revenue is probably change orders. So capturing change orders can be a huge impact. And if change orders, most change orders have some expense to them, so a 4% increase in revenue from change orders is probably a 2% increase in net profit. So you can connect them to profit as well. Everybody contributes to cost of goods sold. You can talk about those initiatives. That travel initiative, that example on the action items would be in the goals for the coming year, but we can talk about how they can affect all that. Here's how we did this year. Here's our expectations for next year. Now we can talk about the goals. So we looked at the financial review. Here's how we did. I know I'll get a question here on how to do company bonuses and stuff. I'll answer that in a minute, or somebody's going to type it in. We'll talk about the initiatives. Again, an initiative, we need to find the leader, the timing, the funding. It's a long term. We're not going to fix this overnight. We're going to put continual effort on this for a long time. That's the message in the meeting. And then action items are shorter term. Again, you have to have an owner. Here's the KPI we're tracking. Here's our goal. Here's the deadline that we want for this. And there tend to be shorter things. People need to know what's going on and who's doing it. So that when someone's asking them to change something that they're doing or alter a process, we might be able to connect it back to one of those action items that we all talked about in the company meeting. Provided that you have the next section, which is Q&A. Now, everybody has a different Q&A style. Some people push it to the end. Some people answer live. Some people do both. As long as people get to ask questions. You have this meeting. This meeting can take an hour. It could take 4 hours. But if you have this meeting, and by the way, you can have it in January. You don't have to have it right before Christmas. You don't need to scramble after this webinar and slap it together. You can have it next month when you have more time. People have a better understanding of what's going on and how they contribute. So there's my view on how to do the end of your year assessment as a management team and take a look at things going forward. So continue to write in questions, and I will get to them in just a minute. And somebody, yes, okay. So I did have the gratuitous bonus question mark. I've had several calls the past week, and I didn't put it into the webinar because it's a how long is a piece of string question. How should we do bonuses? I do want to get one message across about end of the year bonuses and gifts and profit sharing. And I just want to say there are three different things. So if you're an owner right now trying to wonder how to compensate and do something nice for your employees at the end of the year, good for you. Here's my mantra. Here's how I lay it out. A holiday gift or Christmas gift, whatever you want to call it, that check you give somebody at the Christmas party. For most of you, I strongly encourage you to treat that as a gift from the owner. In as much as that I expect the owner to take a draw and take it out of their own bank account, go get the $100 bills or whatever it is that they want to do and put it in an envelope and hand it to someone. And it's a gift. It's not a company gift. It's a gift from the owner. Now, not every owner is in a position to do that, and all companies have owners working in the business. But if it's possible to make it a gift from the owner, that is the best way of doing it. There's frankly, it's a gift. You don't have to report the taxes. They can just fold it up, put it in their pocket. You don't have to, gross up a check like you would in a bonus. So gift, bonus comes from the company. So if you want to do bonus checks to the company, the standard operating procedure is say, I want everybody to have a $500 bonus. Great. I need to gross that up, cover the taxes for that, so they have a debt $500 check, hand them the check. And then the third thing is the profit sharing. If you do some sort of profit sharing or 401k contribution, that is a separate thing entirely. So make sure that these three things are distinct. It's like the person who has a birthday on Christmas Day or around Christmas. You can't just say, hey, here's your Christmas/birthday present. The ideal thing is to say, no, here's a Christmas present and here's a birthday present. Here's a Christmas party. Here's your birthday party. Do the same thing with your employees if you're giving them a bonus. So let me step off of that soapbox and let me move on. I love left field questions. Thank you. Some production companies charge sales tax, some don't. I've seen it in different states from Texas. Some get red flag for taxes, others do not. Can you direct me on who might know? No, I'm not going to cover sales tax in this webinar, but shoot me an email. Let's set up an appointment. I'd be happy to talk to you about that. We spent a lot of time, we spent a little bit of time in the management workshop talking about it. There was certainly a lot of conversation at the tables during meal breaks and at the bar and that sort of thing. So anything related to that, I'm not a tax advisor. I'm not going to give you tax law, but I can give you some anecdotes and help you understand more about that question. So anytime you guys want to schedule some time with me, I'm happy to take a few questions from you. Now, let's move on. Let's talk about next year. Leading indicators. So the question we're asking is, what's next year? What's 2019 going to look like? How much should I budget? What should I plan on? Are we going to have a good year? We're going to have a bad year. If we don't know, how do we plan? Let me tell you the things that I look at. And this is my take and my take only. And I'm very good at revenue forecasting. I've been very good at predicting things. Though I would say right now is probably the most difficult time in my career to predicting what an upcoming year might be like. So I break this in different categories. I'll start with leading indicators. Leading indicators are usually the things that we all have access to if we just pay attention to them. Lead times, okay? Lead times on projects, when are clients re-engaging? Are they getting shorter and shorter lead times? When I get a new RFP, how far out is the project? If I get inquiries, how far out are they? If I start paying attention to the initial contact and when the event is and the amount of time in there, that's my lead time. So we've moved from people contacting us 120 days out to moving 90 days out. That says that lead times are shrinking, which tells us something. When lead times shrink, that suggests volatility in the marketplace. People are getting a little bit nervous. They're waiting a little bit longer before they commit to spending money. During the recession, the Great Recession, we were down to lead times of weeks, of 2 to 3 weeks on major projects because people were so careful about spending money. This past year, lead times have been fantastic. 3-4 months on projects, 6 months on major projects. So look at your lead times. Right now, I see lead times kind of leveling off. That's just my opinion based on what my clients are asking me about, the meetings that I'm sitting in. I think lead times are getting a little bit soft, but they haven't made a turn yet. Another leading indicator is confidence, your confidence in your short-term forecast. You should always be forecasting revenue. You should have a 30, 60, 90-day forecast. If you're going to have a bad March, now is the time that you need to be thinking about it. Okay. And how do you know you're going to have a bad March? Well, if you don't have any projects lined up or you have fewer projects than you did last year, that's a leading indicator that your March is going to be softer than it was last year, and you might need to adjust. So how confident are you in your forecast? When your confidence wanes, it's usually an indication of other things that are going on. So, trust your gut. Your business gut plays in here. There's a lot of gut checks and looking in forecasting. So if you start feeling uncomfortable about the revenue number you threw out for March or February for your budget for next year, and you're not feeling really strong about that right now here at the end of December, okay, that's a lack of confidence. That's going to suggest, again, volatility in the marketplace. And then surprise factors. How often are you being surprised? That's a weird metric to look at, but when we're busy and plodding along, we're generally not surprised. Business is pretty steady. We're amazed at somebody calling us at the last minute for something when the economy's good. So that's a surprise factor. So if you're starting to be surprised by things, that's suggesting that there's changes in the marketplace we might need to pay attention to. As an industry, we are leading indicators. Our businesses, our production rental, live events business will go soft sooner than most other businesses because we're very often a discretionary spend. And when our clients get a little bit nervous about what's coming up, and they have better crystal balls than we do, by the way, they're forecasting out much farther than we are. When they see softness, the spending that they use in our world gets cut most quickly. So I look at leading indicators, but I also take a macro view of things. And I want to look at what the world is going on. Now, this is the MBA in me, and I love macroeconomics for some weird reason, maybe because it had calculus in it. But customers have economic views. And if we're talking to our customers, we start to get a sense of what they're seeing. Many of our clients are international corporations. We may be dealing with the marketing manager of the Northeast region of a pharmaceutical company, but the fact is that's a multinational corporation that is pushing down policies and initiatives and budgets based on what's going on in the entire world. So listen to what your customers are saying. Listen to what your clients are saying in the meetings that you're putting on for them, because there's great intelligence in there. I'm also going to look at the national or regional economic trends. If you're a national company, obviously the national economic trends matter more. Regional companies, as many of you are, your region doesn't necessarily track with the national economy. So I'm looking at unemployment trends, I'm looking at access to capital, and I'm looking at inflation. Right now, unemployment seems to have flattened out. I mean, nationwide in the U.S., a 4% unemployment, or just under 4%. That's about as low as you can go without economic hardship. Too low of unemployment is a problem. Unemployment has flattened out. Payroll has not increased correspondingly like one would expect. That's an interesting trend that says the major corporations don't plan on staying here. They're expecting higher unemployment in the future. Access to capital is still good. The interest rates we're paying right now are nothing. Somebody asked me a question, a younger person asked me a question about this at the workshop, saying, hey, my interest rates are going to go up a percentage point next year. Should I be concerned? I said, what? It's going to go from 3 to 4%? I work with business owners who started their companies in the 1980s using credit cards, and we're paying 24% interest. My first mortgage was 14%. So the interest rates that we're seeing now are not really significant. But as interest rates do creep up, access to capital will be affected. Honestly, right now, there's no money being made in the stock market or the bond market, the futures market. It's very difficult to make money on paper right now because of all the uncertainty. There's a lot of capital available because you are a better risk than some of these market investments that they can make. So if you're going to borrow money, now's probably a good time to do it. And we're not seeing inflation, at least not in the U.S. These are all pretty stabilizing trends. So I'm not getting a lot of noise from my macro, national, and regional trends. So there are market areas within the country that might be a little soft. In other words, your results may vary. As I just said, the markets are really volatile. When I went to grad school and learned about market theory, and back then this was during the Enron days, when Enron was a thriving, visionary company making tons of money, until we found out it was all a sham, and the markets have never been the same since. So the original theory, the pre-2001 theory on the stock markets, is that the markets were always rational. The current theory right now is that they're not rational at all. There's no rhyme or reason to what the markets do. It's designed to make money when anytime there's a blip. If the market shoots up, if the market shoots down, the investors are making money. That's why they welcome the market changes. It's probably why they welcome the current administration, because they introduced so many changes to the market that they can make money at. So right now the market is pretty volatile, which makes me concerned. Now, micro view, I look at costs. As I just said before, labor costs have not gone up, even with the low unemployment. The general cost of resources have not gone up. I'm not seeing an increase across the board on subrental costs. Pricing seems to be fairly stable. I also would look at my internal close rates. How well am I closing on jobs? If my close rate is normally 40%, am I increasing or decreasing from that? And how are clients paying? What's the payment trends? People paying cash is a good sign. People asking for terms is a bad sign. So factor all of these things into what you're seeing. And then, so here's my crystal ball. On a macro basis, worldwide investor volatility, lots of uncertainty worldwide. Discretionary spending seems to be in check. In other words, nobody's pulling back, but nobody's overspending either. And I'm expecting a recessionary bubble in the US at least, or North America at least, by the end of 2019. The question is when and how big. I don't have the answer to that. If I did, I probably wouldn't be doing webinars for a living. So why does this matter? Watch your pipeline for softness. Okay, this is an early warning sign of a downturn. One bad month is not an indicator, but 2 bad months probably is. If you are planning on doing a lot of speculative CapEx in the second half of the year, I'd avoid it. If you can get a return on an investment now, I would go ahead and buy it. But by the end of the year, by the second half of the year, I'd be sitting on that money or sitting on that capital until we have some more certainty in the forecast. I would reduce my Q3 and Q4 forecast until we see some changes in the macro view. You may get to the middle of the summer and your forecast for Q3 looks great. Awesome. Increase your forecast, make some adjustments on the fourth quarter. But I think by May, you'll have a real good idea of what Q3 and Q4 are going to look like. My micro view, we got low U.S. unemployment. We have a lot of M&A activity. And the reason is these investors who have all this money that they don't want to put in the stock market because it's too volatile are buying companies. There's a lot of M&A activity. We've seen some big 3-letter companies put together, merged under a new parent company, that sort of thing. The good news about M&A activity is it creates churn. Churn means that I have people coming and going. So we see people leaving large organizations that have just been bought as they right size. They often go start their own companies, or they go join a company and bring their skills and talents into that organization and create new revenue streams and initiatives for them. So we will end up seeing more small competitors pop up. If we do have an economic downturn, we'll see even more small competitors. That's a great time to start a new business, is during an economic downturn. I'm also seeing a lot of buying groups in play. That's an up economy thing. We can afford to pay a middleman to consolidate our buying. If the economy goes down, I think those buying groups will become less effective, and we'll have more direct spending from our corporate clients. So why? So what? Improve your marketing. Okay. Right now, the economy is still pretty darn good. You want to be getting market share. Marketing is the way to do that. You want to increase your leads and prospects through marketing. You want to leverage whatever pricing and cost advantages that you might have. I won't say go out and buy business by dropping the price, but if you can leverage pricing to win some business or get a multi-year contract, now is the time to do it. Market share will help you survive the recession when it happens, not if it happens, but when it happens. So picking up a little bit of market share means you can afford the attrition that will naturally happen if we have a downturn. So start off with a bigger number. So I'll probably have time for a couple more questions here, and I'll do some final thoughts. Oh, goodness, no, we are at the end of the hour. All right, let me see if there's any questions here that I need to answer. And all right, let me talk about next month's webinar. Next month's webinar is strategy for people who'd rather be working right now. You know, every time I say the word strategy in front of a group of people, eyes roll, and it's like nobody wants to talk about strategy. You know, we want to talk about getting work done, and that's what I'm going to do in that webinar. I'm going to tell you how to get the touchy-feely side of strategy out of the way so you can talk about getting down to business and having a strategic plan that actually does something, which is what most of us want. So register for that. Jumpstart workshops. In 2018, I just want to give you a quick statistic. We had 4 workshops this year, 253 individual attendees, unique attendees. 77 companies participated. 50 of those companies sent more than one attendee at a time. And 20% of all the attendees came to 2 or more events. So we had a fantastic year on Jumpstart workshops. We had some huge audiences, exceeding my expectations, exceeding my event planners' expectations. It's been a great success. So I hope you'll take a look at next year. And we'll be getting more announcements out about this. But right now, we have 4 Jumpstart workshops set for 2019. Strategy, marketing, operations, and management. Operations, folks, please note, we moved you to August when you're probably more available than May. So I expect another stellar turnout for operations in August. And just be sure you're on the mailing list. If you registered for this event, you already are. And yeah, everybody's seen the book. And you get the newsletter and introductory conversation. For those of you who asked a question that I didn't answer because it's not really relevant to the webinar, just schedule a free call. Guys, I got 20 minutes for you, no problem. I'd love to talk to you. Those of you who have done it know how much I enjoy that, so I encourage you to please give me a call anytime you want, or schedule a call. After the first of the year, though, please. I'm going to take the holidays off. And a final thank you to our workshop sponsors. We hope we'll see you all back in 2019. If you're a potential sponsor listening to this call, please reach out. We'd love to talk to you about our sponsor and advertising programs for 2019. So some final thoughts, and I'll let you go. My point in all of this end of the year management stuff is that there's a lot of things you need to exert continuous effort on. Okay. All aspects of your business need attention. Find out what you've not been putting enough effort into and figure out how you're going to give that continued effort next year. You can't just push something once and then expect it to hold. You got to keep coming back to it and reinforcing it. Time is your most valuable asset, and anything that you do that saves time for you, saves time for the organization, your employees, and your customers is valuable. It's extremely valuable. Focus on how to save time. Time is money. You may spend more money in order to save time, and it is probably going to be a good investment. Take a business approach to making money. Okay? Making money doesn't just happen. You have to do a lot of things right to make money. And that includes going back and looking at how well you did and making a difference. So I want to thank all of you for joining me and spending some time. It's been a wonderful year of webinars, and I look forward to doing some more next year. And may I be not the first or the last to say Merry Christmas, Happy New Year, Happy Holidays, whatever you may be celebrating, happy open bar, happy time with your families. And thank you guys for all your support. We'll talk to you next year.